Okay, let's dive deep into the energy sector today. We're looking at some recent investment performance, really trying to figure out if the market's hit an inflection point.
Exactly. The mission here is to pull together an investment update focusing specifically on, I think it's 5, published ideas since last August,
Right, 5 of them.
and see how those returns connect back to the bigger picture, the sort of macroeconomic shifts creating opportunities right now.
So the key takeaway for you listening is you're essentially getting a shortcut here, a way to understand the potential value in these often overlooked energy investments. Okay, so let's ground this. Let's talk performance based on the source material we reviewed. Since August 25, these 5 ideas, well, they've done pretty well against the market.
Consistently well, yeah.
We've got a deep value natural gas play, up 33%. Another one called From Money Pit to Money Maker, that's up 27%.
And what's critical there is every single one outperformed the broader energy market index, the XOP. That's the benchmark for exploration and production companies.
Okay, so consistent outperformance. But there's one number here that just leaps out.
You mean the big one?
Yeah, the 1,000% plus opportunity idea from mid-August, up 483%. I mean, wow.
Yeah, 483% in, what, just over 2 months? It's pretty stunning.
It absolutely is. Now, numbers like that often scream high risk. Was that the case here, or does it tell us something deeper about the sector?
Well, it tells us a couple of things, I think. First, yeah, there was risk, but it was calculated. It was tied to a specific sort of temporary operational issue, not a fundamental flaw in the company.
Okay.
But second, and this is maybe more important, that kind of explosive return happens when there's a major market disconnect, a structural issue that's been brewing for years.
And that disconnect is really the core theme, isn't it? This outperformance isn't just random luck.
Not at all.
It stems from, well, years of the market just relentlessly selling oil and gas stocks.
Yeah.
Especially the smaller ones, the smaller producers.
Exactly. It was driven heavily by, ESG mandates, pushing institutional money out, capital starvation, basically.
Yeah. Which left these companies trading way below their actual asset value, right? Their cash flow potential.
Precisely. A huge gap opened up between market perception and the underlying reality of the assets. That's the opportunity the source material aimed to highlight, finding those mispriced companies.
And now it seems like that historical discount is meeting some powerful tailwinds.
Right. That brings us to the inflection point. Why now? There are 2 huge developments really changing the game.
Yeah, let's take them one by one. Factor 1 you mentioned is booming energy demand.
Yeah, and specifically it's driven by AI, artificial intelligence data centers. We're talking about unprecedented growth in electricity demand.
Right, I've been hearing a lot about that. Massive power needs.
Massive and constant. These things run 24/7. And the reality is natural gas is likely going to be absolutely central to meeting that demand reliably. Renewables are great, but they're intermittent.
They can't provide that steady baseload power AI needs.
Not consistently, no. Gas turbines can ramp up quickly and provide that dispatchable power needed to backstop renewables and meet these huge new loads.
Okay, so AI demand is a huge new factor. What's the second piece? You mentioned inflation and U.S. debt.
Yeah, factor 2 connects energy to the broader financial picture. The source material highlights the U.S. debt is projected to hit record levels relative to GDP. We're talking levels not seen since, 1790?
Going back centuries, that's sobering.
It really is. And when you have debt climbing like that, alongside lingering inflation worries, investors naturally start looking for hard assets.
And oil and gas fit that bill.
They absolutely do. People think of them as cyclical, which, okay, they are, but they're also productive hard assets. They literally power the global economy.
So they act as an inflation hedge.
A pretty effective one, yeah. Their value and cash flows tend to rise with inflation, offering protection against currency debasement in a way financial assets might not.
But hang on, what if fighting inflation means a really sharp recession? Won't energy stocks just fall with everything else then? Where's the protection?
That's a fair question. But the hedge is in how essential they are. Even in a moderate recession, the world still needs energy to function. Plus, these companies have been priced for years like they're dinosaurs, like they're dying out.
Right, the ESG pressure we talked about.
Exactly. But now you have this AI boom demanding their product. So they offer this kind of rare combination, potential for growth and inflation protection, because they are so fundamentally necessary.
Okay, so let's try and wrap this up for the listener. We've seen some really compelling performance numbers.
Yeah, born out of those market discounts.
Discounts which are now meeting these huge shifts, AI needing more power, and global finance worries pushing people towards hard assets.
Right. So if this kind of deep, data-driven look at overlooked energy companies resonates with you, if you find value in understanding the specific names and the reasoning,
Then, becoming a paid subscriber gives you access to future investment ideas like these, plus the back catalog and analysis of the ones we just discussed.
it's about getting that ongoing insight.
And there's a specific offer right now. Founding memberships are 50% off, but only through the end of this month.
So maybe a final thought to leave you with.
Yeah.
Given where U.S. debt is heading and this absolutely massive, undeniable energy demand coming from AI, what's the real value of these energy companies, not just as a hedge, but as the essential fuel for the entire future economy?
Something to think about. That's our deep dive for today.